What is day trading? Day trading is the practice of buying and selling financial instruments throughout the day. As the day progresses, price will increase and fall in value, creating both the opportunity for gain and the possibility of loss based on the market you've selected. As a day trader, fundamentals also play a role in determining whether you profit or lose on your trades. So what I mean by this is once you're a day trader, you shouldn't just only focus on your technicals. So when you look at the markets, you shouldn't just, look at a financial instrument and just, place your trade on whether it's moving up or down. You should analyze and you should also add fundamentals to that. Okay, so the next paragraph there says you should not consider day trading if you aren't patient and willing to take a couple of losses along the way to being a full-time trader. Being patient comes with waiting for a few hours for your entered trade to play out. So day trading comes with a lot of patience, you know. You shouldn't just expect to come in and out of the market because day trading, as we all know, with day trading, trades can take up to a few hours, to a whole entire day for your trade to play out. So you should also really be patient because if you don't have patience, there's a high chance that you won't make it, you won't make it because then you just want everything to happen now. And once by doing that, you're making rational thoughts, which will what end up resulting to you taking losses in the market, not learning from your mistakes and all that. How to get started. You are required to determine your why and goals before getting into the trading industry. Therefore, trading has a purpose to you. Most traders who come into the industry without a why are the same traders who aren't willing to put in the work, which results to accounts getting blown, and those traders will barely see growth in the markets. So what I mean in this paragraph is once you have a why, just like anything in life, once you know why you're doing something, you're gonna work harder, you're gonna put in more work towards that, and also once you know, let's just say you're working to quit your job, that's your why, or your why is you just want to get your family in a better situation, or your why is you just want to buy your dream car, As long as you know that, at least I have to work this hard to actually what quit my job, to what buy my mama a house, buy everything, just set your life so you have a purpose, so you're not just trading for the sake of saying I'm a trader. You have a purpose, And the next paragraph says determining your goals and what you hope to achieve with trading will help you stay motivated through the ups and downs of being a trader. Your goals should be realistic, as most traders come into trading with hopes of being rich overnight, which is very rare. So it's better to come with a more calm mindset, because just like any other industry, you have to work to get to the top. So what I mean in this paragraph is once you've determined your goals, you've written them down and everything. This will help you stay focused because trading isn't easy. It's not just once you start trading, your life is just gonna go up. No, once you start trading, yes, you are doing it to take your life to a different, to new heights basically. But then getting to those heights, there are gonna be ups and downs, there's gonna be obstacles. But then to overcome those obstacles and for you to continue with your journey, you need to know, you need to look back, maybe go back to your notebook and be like, read your goals out, to keep you motivated. Read that, oh, I need to do this to get my new car. I need to do this because my mother needs my help. This, and that, So those type of things will what keep you motivated and get you going. What you need to start trading. The first thing you're gonna need is TradingView. TradingView is a platform that offers a range of features and gives traders access to real-time financial data and advanced charting tools to analyze the market and make informed decisions. So basically, TradingView is what you use to basically analyze and get your prediction of where you think the markets would go or where you would like it to go. Next up is MetaTrader. MetaTrader is a trading platform used by traders worldwide for trading a variety of financial instruments. So MetaTrader is basically the app you use to place your trade. Once you've analyzed and ready to initiate a trade, basically, you can move on to what the next app, which is MetaTrader. Next up, what you're gonna need is a broker. A broker is the link between the trader and the financial markets. It provides the trader with a platform to access the markets, execute trades, and manage their accounts. A forex broker can also offer various trading tools, educational resources, and customer support services to help traders make informed decisions. So a broker basically is what allows you to, for you to deposit, to withdraw, and all that, So that's why it says a broker is the link between a trader and the financial market. That's how you would be able to deposit your money so you can trade with that money. Once you've made your money, you have to withdraw. So all those transactions basically are made through a broker. And the last thing you're going to need is Forex Factory news fundamental coverage. Forex Factory is an online platform that offers real-time information on the foreign exchange market, including news, analysis, and economic events. It is a popular resource for traders and investors looking to stay up to date on market trends and make informed trading decisions. Forex Factory is used to look at news. So remember, in the previous slide, we spoke about how traders need to also include fundamentals in their trading. So this is where fundamentals come in. Once let's just say you've analyzed and you're basically ready to take a trade or anything, you can go to what Forex Factory for another confirmation or confluence, checking news that will be dropping on a specific day and how they would affect your trades. Selecting a market. Selecting a market will help you focus on certain instruments that are within your desired market. It's better to start off with one so that you don't confuse yourself and overcomplicate things. But once you found your way in the market, you may move on to other markets. Within the Stacks FX 2.0 strategy, you have two options at which the strategy can be implemented, which is the Forex and indices market. So selecting a market, this all depends on what you're looking to trade. Are you looking to trade Forex? Are you looking to trade indices? Are you looking to trade stocks? Are you looking, all those type of things? But then I advise you, especially this is for beginners. As a beginner, I advise you to pick one market, whether it's stocks, Forex, indices, pick that market and only trade that market. Only trade that market, know more about that market before you're able to move on to the next thing. So it's better to master one. Once you've mastered that, you can move on to the next. So within the Stacks FX strategy, you're able to trade the Forex, the foreign exchange, which is currency pairs and all that, and the indices, your NASDAQ, US30, and all those. So selecting markets basically is another important role. You need to know what you're trading. You need to know you're not gonna one day trade stocks, the following day you take trades on indices, the following day you shouldn't do that. You're gonna confuse yourself. But once you are a professional, and you know your strategy and everything works out for you, you have a trading plan, you follow it, you disciplined and everything, then that's when you can move on to other markets. So that's it for selecting markets. Psychology in trading. Psychology in trading is one of the most important things a trader will need to master in trading in order to be successful. Because your psychology is basically your brain, what happens, what's happening in your brain when you take a trade, what's happening while you're in a trade, what's happening after you take a trade, all those things are important and all those things add up to whether you make money in the markets or not. So the first point we're going to be looking at is emotions in trading. One of the most important things to understand about psychology in trading is the impact of emotions on trading performance. Fear, greed, and overconfidence are some of the common emotions that can lead to poor trading decisions. The next is discipline and patience. Day traders need to have discipline and patience to be successful. This means sticking to a trading plan, following rules, and being patient with trades. So discipline is another thing that you need to get yourself disciplined. You need to find a way to keep yourself disciplined within the markets. Be disciplined to wake up at a certain time. Discipline doesn't only mean you being disciplined when you're looking at the charts. No, for you to actually be disciplined within forex, you need to be disciplined with what, with other factors in your life. Wake up at a certain time. No, at 6 a.m. Just like with me, I know at 6 a.m. every morning I'm up. At 7, I have to be out of bed. At 8, I have to work out this, and that. So those are the type of things you can use to build discipline. Write down, write all these things down, that at this time I have to be up. At this time, I have to be looking at the charts. When I look at the charts, what am I looking for? For you to be disciplined, to be like, tomorrow I'm gonna be analyzing the chart, but what I'm only gonna be analyzing, let's just say 10 pairs. Be disciplined enough to actually analyze those 10 pairs. Even if, let's just say, you analyze those 10 pairs, but then what? You could only maybe see movement within only four. But then you've analyzed 10. Don't go now, try analyze 11, 12, just to find more trades that are moving how you would like. Be disciplined. When you tell yourself you're gonna do something, do it. Don't lag. That's discipline within the trading. And then the patience part comes in, as we said. Day trading comes with time. You need the patience. If you lack the patience, you're not gonna be profitable within the market. And if you don't have patience, you're lacking discipline. So that's discipline and patience are also really, really important. The next point is mindset. A positive and confident mindset is important in day trading. Believing in one's ability and having a growth mindset can help traders to overcome challenges and achieve success. So, having a positive mindset, what does that mean? It means you going into the market, believing in yourself, not being scared. You can't go into the market saying, yo, I'm scared. What if I take a loss? Yes, you are. There's a chance of you taking a loss. But then if you have a strategy, something you've been implementing for years or for a certain period of time, you've built your discipline. By the time you go into the market, you're gonna be confident, which means analyzing a chart with confidence, it means it reduces the stress of when you enter the trade, reduces your stress when you're in the trade, because then what? You went into that trade with what? Full confidence. You weren't going in doubting yourself. When you go into a trade doubting yourself, you might enter when price just moves, let's just say a few pips in the direction that you weren't predicting. You start shaking, you start, your hands sweating. Now you don't know whether should I close or not. But then if you are confident and you have the discipline, you want to enter a trade, and the only way you're going to come out is what? Either stop loss or take profit. You're not going to just close trade just because you feel like it. So mindset is really, really important. So believe in yourself. That's why I put in the work, so that by the time you are gonna get into the market, you are confident of what you're doing. This is a move that I predicted. So yeah, believe in yourself basically. The next point is risk management. Risk management is a crucial part of day trading. Traders need to have a plan for managing risk and be willing to take losses when necessary to protect their capital. Risk management basically means how you wanna manage your money once you get into trading. How are you gonna limit your losses? How are you gonna get the most profits in the markets that you can? So every trader needs to have a risk management plan that they've set out for themselves, that they've set out. Whether it depends on the trader, how much are you willing to lose, how much are you willing to put in, all those type of things. But risk management is basically you knowing how to control losses and how to limit your losses in the market. Dealing with losses. Losing trades are a normal part of day trading. A trader's ability to deal with losses and bounce back from them is an important part of the psychology, So dealing with losses. What we can say about dealing with losses is, let's just say you analyze, and you take a trade, and the trade goes what in your opposite direction, hit your stop loss, So now you add that trade. So dealing with the losses, how let me give you two examples of how basically a beginner and how a professional would handle the loss. As a beginner, you'd probably handle the loss by going in and taking another trade, or looking for opportunities to make your money back. That's how a beginner would handle their losses. But a professional, would handle their losses by they take a loss, they go back now to what? The trading plan and everything, and they see, did I follow all the steps before entering this trade? What was my mindset, while I was in this trade? And they go back to the journal and they write all these things down, So what? The next trade they take is what? Is profitable, because they've learned from their mistakes, Don't go in and revenge trade and everything. If you've taken a loss and in your trading plan, you say, if I take one loss in a day, I'm done trading. No, yes. So stick to that. Don't tell yourself that after a loss, you're done. But then once that loss actually hits you, your psychology, switches up, So now you decide, let me know, let me take one more trade and try to get my money back. That won't work, There's a high chance that you want to lose more money, lose more money, lose more money. So when you take a loss in the market, is step back, don't go into the market, step back, evaluate the trade. Why did you take a loss, And if you did everything right, then it wasn't on you, it was just what? Market conditions. Then look at those market conditions, how did these market conditions affect my trade, So that's the difference, Don't go in revenge trading or trying to make more money than you lost. The last point is mindfulness and self-awareness. Practicing mindfulness and self-awareness can help traders to stay focused and present while trading, reducing the impact of negative emotions on the decision making. Sorry. So basically, mindfulness and self-awareness is you having that mind state, of, I know what I'm capable of and I know what I'm not capable of, self-awareness. That's where it also comes in, So you know what you're capable of and you know what you're not capable of. So by knowing that, if I do this, you are aware of the risk, So, and if you don't do this, you're limiting you what can I say, you're limiting your emotions, you're basically limiting what? The negative emotions, because you know that if you do this, you're probably gonna react in a certain way, So just like I can make an example of, like, you see a trade going, let's just say a trade is going up, but then you've actually just missed it just by a few pips, you missed your entry where you were supposed to initially enter. You missed it by a few pips, But then now, the trade is going in your direction, in the direction you predicted. Are you gonna what? Go against your trading plan or everything and enter where you're not supposed to enter? Or what? Are you gonna be aware that if I do enter at the wrong place, my emotions are gonna take over, I won't be sure now because my stop loss is probably gonna be bigger, which means I'm losing more money, So self-awareness is you knowing yourself, in every aspect of trading, you knowing how you're probably gonna act if something happens, if this and that, So just keep that in mind also. Be be mindfulness of, what can I say? Be mindfulness of the things that can happen within trading, Be aware that you can lose money, you can make money as well, but then be aware of the negatives, basically. That's what I'm trying to say. Most people look at the positives only, but then there's also negatives within trading, There's both positive and negatives. You just need to be aware of that. And once you are aware of that, then positives will outweigh the negatives. So that's it for psychology in trading. Trading plan. A trading plan is a written set of rules that outlines a trader's objectives, trading strategies, and risk management techniques. A trading plan helps traders stay disciplined and focused. and aids in the development of consistent trading habits. It also helps traders to avoid impulsive decisions, emotional trading, and excessive risk taking, ultimately leading to more successful and profitable trading. So, what I mean by this is once you have a trading plan, it's something that you've written down, it's rules that you set out for your own self, so those rules are meant to help you stay disciplined within the trading market. It should help you understand that when you open the charts, what are you looking for? Your strategy should be based in your trading plan. What are you looking for when you open the charts? Are you trading with trend lines, with support and resistance, with Fibonacci, with anything? But then you should always follow what you have written down. And also, once you have your risk management within your trading plan, are you following that risk management? Are you not going overboard, when it comes to managing your money? Are you not getting carried away when you lose a trade or when you even win a trade? Because you can get carried away when you win, that you might want to go back in the markets to make more money. But then if you have a written rule in your trading plan that says, no, in a day I can only maybe take two trades, so if those two trades are profitable, whether they're profitable or not, you stick to your trading plan. You don't go over that. So a trading plan is really important. It's gonna help you stay disciplined. It's gonna, you know, let you know what you're looking for when you're in the market. Let you know what how are you gonna get out the market when you're in a trade. So those are all the things that a trading plan is gonna help you with. So what to include in a trading plan: market, time frame, market condition, risk management, entries. So these are all the things that you need to include in your trading plan. So market, you need to include what type of markets are you trading. Are you trading indices? Are you trading currency pairs? Are you trading stocks? Are you gonna be trading metals? Write that down so you know that when it's time to actually analyze and stuff, you don't just trade whatever you feel like it that day, or you don't trade what you see someone else posting. If it's not in your trading plan, you're not gonna trade it. Then next up is time frame. Know what time frame that work for you when you analyze the markets. Are you going to start from the weekly, move down to the daily, 4 hour, 1 hour, or you're going to start from the daily, move down from the daily, or you're just going to start your analysis on the 4 hour time frame? Write those things down so you know how to approach the market from what time frame, at all times. So it's not a thing that's always changing. Today you analyze on the daily, tomorrow you analyze on the weekly. No, have a trading plan, write those things down. Then every day when you're about to approach the market, you look at your trading plan, you check. So next up is market conditions. What type of conditions are you gonna be trading? Are you trading when the market is ranging, or are you only trading when the market is trending? Those are also important things you need to know when you want to go into the market, because you don't want to be that person that trades everything. Yes, it's possible for you to trade every market condition, when it comes to the experience. Like me, I can trade a ranging market, I can trade a trending market, I can trade different market conditions, but then that also comes with experience. So it's better to know what are you gonna be trading. So as you can see, even on your trading plan, once you know you've mastered both, maybe you can write there that you trade what trending markets and ranging markets. But then as a beginner, or what I would just advise in general, as a trader, is that have one thing you stick to, have one thing you stick to. Then the next thing is risk management. This is also key. This is one of the most important things that you can have in your trading plan. Risk management. Know what risk to reward ratio are you gonna be using when you enter a trade. What percentage of your account are you gonna be risking when you enter a trade? We're still gonna get more, like I'm still gonna go into risk management in depth But then this is just, an outline of just you need to include it in your trading plan, within your trading plan, And then the next thing is entries, When it comes to entries, how are you entering? What's making you enter a certain trade, Are you just entering every time you see the market push up? Are you entering every time you see the market push down, Are you entering using patterns, certain patterns, bullish flags, double tops, anything like that? Are you entering when you see a breakout of a zone? Are you entering when you see a breakout of a trend line? Are you entering when price pulls back to a certain level? Those are also things you need to write down so you know. So you see, everything I've mentioned now is basically everything you wanna need when approaching a market, So your trading plan is initially, as we said, it's a set of written rules, So once you have this set of written rules, every time, every day, every single day, this is important. Every single day when you're gonna go into the markets and you plan on trading that day, take out your trading plan and read it. Read all the things. Read your market. Read your time frames. Read your market conditions. Read all these type of things, and make sure that you follow these rules, So, and as long as time goes by, you won't need to read them because what you're doing it every day, so it's gonna be in your mind. Like I don't read my trading plan now, It's something that I know it's just instilled in me, I know that I trade this. I know I enter when I see this. I know. But then as a beginner and stuff, I advise you every single day, do not trade or do not go into the markets without having your trading plan right next to you, because that will just help you build a discipline. That's how you build discipline within the markets. You're not going to build discipline if you only look at your trading plan once in a while and you only follow it under certain conditions. No, you have to follow it regardless, If your trading plan is saying today you're not trading, that means today you're not trading because your trading plan is you at the end of the day, It is you. So why would you not listen to yourself? You wrote those rules down for you to follow, to make you better, to build discipline within yourself. So a trading plan is really, really important, It's really important. We're still gonna get deeper into this, within with all the members and everything. I'm just gonna help you, This is just, I've given you an example as well, just here, as you can see on the screen, of how you can lay it out. You know, this is how your trading plan could look like or should look like, rather say. So don't forget, trading plan is really important, guys. Really, really important. And also, another thing is you can add more things, the things that I've just given you are just minor things, or the most important things. You can add minor things, write down, that maybe you only trade on what certain sessions, you only trade London session, you only trade what New York session, you only trade Asia. Write those things down. Write those things down at all times. What maybe you trade only one pair, write that pair only down there by market and you stick to that. You only what trade that certain pair, you know, like write down so many things, write down your own rules to help you build discipline and to help you stay profitable within the market, because you don't want to be coming into the market just free forming, because you're not going to make it once you start free forming in anything you do. You come into the market today, you're using the strategy, boom, it doesn't work. Tomorrow you're using another one. No, that's not sustainable within trading. So follow your rules and success will come, discipline will come, and you'll see profitability within your own trading yourself. So that's it for a trading plan. Journaling. Journals can go along with your trading plan as they both important. A journal is a list of trades taken over a set period. This will help keep a record of your journey, and journals can also be used to backtest strategies. The more detail you include, the more likely you are to improve as a trader. So another thing that's really important as a trader, most traders, get stuck at I call it as a trader's block where you find yourself not being profitable, but But then the reason for that sometimes is just minor things, even, So one of them is journaling your trades. So journaling your trades is every time you take a trade, is you now journaling it down. Are you taking a trade on Euro USD? I'm writing Euro USD. What time did I take this trade? At this time. So a journal basically will help you fix your mistakes, because then you always have something to go back to. Most traders don't have anything to go back to. They make a mistake in the market, they move on, which is not right at all. That's one thing you should never be doing. You make a mistake, you should be able to look back at that mistake. You should be able to look back at that mistake to be like, okay, I made this mistake. Where did I go wrong? Where did I go wrong? Most people will tell you they traders, and then you'll ask them to see their journals, and then they don't even know what you're talking about. How has that person been able to improve themselves throughout their journey, throughout their years? How has that person been able to tell you, maybe on certain days this is when I'm profitable, on certain pairs this is, how is that person able to tell you those type of things? So a journal is like, as you can see here, a journal is a list of trades taken over a set period. So every single trade you take, you should journal it down. You should journal it down. Every single trade, whether it's a winning trade, whether it's a losing trade, it does not matter. It should always be within your journal. That's why it's there. So if it's a losing trade, you go back. Where did I go wrong with this losing trade? If it's a winning trade, you're still able to go back and say, okay, it's a winning trade, but then what did I do right? What did I do right so I can continue doing that? So a journal is really, really important. Really important. This is something I'm always gonna be talking about, just throughout this whole mentorship thing. Journal your trades. Journal your trades. Okay, so what to include in a journal? Instruments, entry direction, date taken, date closed, day of the week, time, type of entry, pip risk to reward ratio, screenshot, comment. You see, these are all the things that I include in my journal. So let's go in and let me explain everything now. So as you can see with instruments, instrument means the instrument you trading, whether it's a currency pair, whether it's a metal or anything. I've also given you guys an example below here. As you can see here, it says pay USD CAD. So that's the instrument I'll be trading, USD CAD. And then here, entry direction. Am I buying or am I selling? So here you can see USD CAD showed, which means that's the direction I was selling. Then date taken, open date, the date you took the trade. Then from there, date close, the date that the trade decided to close you out, or hit TP or stop loss. Then day of the week. When did you enter this trade? Was it a Monday, a Tuesday, a Wednesday, a Thursday, or Friday? You need to jot these things down. I know if you're listening to this, you might feel like, why do I need to do this? But trust me, you need to do this. You need to be able to go back to see. Because once you have all this information, what if you've taken 100 trades and once you study those 100 trades on your journal, you notice that on Tuesdays, you're not profitable. So those are the things that they help you improve as a trader. So maybe now you realize that, okay, maybe if I only trade on Mondays and Wednesdays, that's the when market condition treats my strategy proper. So day of the week and then time. What time did you take the trade? What time did you take the trade? The time will also help you with what session were you trading in? Were you trading in the London session, the New York session, and everything? So that's where time comes in as well. And then type of entry. What made you enter this entry? So as you can see for me here, USD CAD, pair USD CAD direction showed open date, close date, day of the week was Monday, time was 1:42. Entry type was break and retest plus Fibonacci. So that's what made me enter that certain trade on that specific day. It was a break and retest plus another confluence of my Fibonacci. So from there, type of entry, the next thing is pip risk. how many pips are you risking within that trade, how many pips are you risking within that specific trade. So we can see here with me is pip risk is 11 pips. I was risking what? 11 pips. And then the next thing is risk to reward ratio. What's your risk to reward ratio on that specific trade that you took? So my risk to reward was two is to one, So 2 is to 1. And then after that, what you do, you're gonna include, basically, you can also include whether the trade was a win or it was a loss. And then after that, a screenshot. This is also important. Take a screenshot um when you enter the trade, and take a screenshot after you've entered the trade. So what I mean by that is like you've analyzed your whole pair and everything, and you're about to enter the trade. Take a screenshot of your analysis, before, and then take a screenshot after the trade has played out, whether it's played out to your TP or it's played out to your stop loss. Take two screenshots. And then the last thing you wanna need is a comment. So by comments, I mean like after the trade has played out, write a comment for yourself, whether it was a good or a bad trade. Don't forget, write a comment for yourself. Sometimes there might not be any comments to be written, but then most of the time there's gonna be a comment, especially on your losing trades. So by comment, you're gonna write, if it's a losing trade, you're gonna write what happened, what made you lose this trade, or maybe you're gonna write the USD CAD, this fundamentals kicked in, and I wasn't aware of fundamentals. So you're gonna write that. So the next time you check your fundamentals, or what you can write is what can I say? Oh, you're gonna write, I entered too early. I didn't wait for confirmation. So the next time, you have to wait for confirmation. So you enter at the right time. So that what it helps with everything. So journaling is really, really important within your trading. Risk management. Risk management in trading involves identifying, assessing, and prioritizing potential risks associated with your trading strategy. The goal is to mitigate these risks and minimize losses while also optimizing returns. This can involve a variety of strategies, such as diversification, setting stop loss orders, and monitoring market conditions. The ultimate aim is to balance risk and reward. So, what I mean in this paragraph is that your main goal while you're in the financial markets is to minimize your losses, and optimize on your profits and on your returns. So how do we do this? We do this by having a balanced risk to reward ratio. Well, I wouldn't really classify it as balanced, but then we're still gonna get to that, later. Risk capital, the amount of money you are comfortable losing. This will differ from one trader to the next. And if you risk more than you can afford, it's more likely that your psychology towards the market will be affected negatively. So what I mean here is that when you trade with money that you are willing to lose, don't trade with money that you need. You know that you have that money, but then you need it for what? Something more important, and then you decide to trade with it, because once you do that, you wanna come in to the financial markets thinking that you have to make a profit from that money. No, the financial markets don't owe you anything, so you don't have to anything. So when you come in with money that you aren't willing to lose, you come in with a mindset that's already off, which is gonna affect your trading. So rather come into the financial markets, with money that you're willing to lose, so that also once you start trading, you don't have thoughts of like you have to win this money, because if you don't make profit from the markets, it's going to affect you out elsewhere. That's too much pressure on you as a trader. Risk per trade. How much money are you going to risk per trade? 1 to 2% of account balance. Calculate lot size. So this everything here is basically point on, risk per trade is just how much you're gonna risk. Every trade you wanna take, how much are you risking? That's gonna depend on you also. That's where it comes in. Each trader is gonna have their own, different amount. But then the second point is important. this is, you need to pay attention to this. Then you risk 1 to 2% of your account balance. That's how you become, that's how you stay in the markets for long. Some people, you find them risking 70% of their account, or 50% of their account. So how you can look at this is, then let's just say you risk 50% of your account, and let's just say you have um $1,000. So you're risking 50% per trade. Is that, let's just say you take a trade and then you lose. That means you've lost what, $500. Now you left with $500. And then you take your second trade and then you lose that. That means your account is blown because what, you've risked 50% per trade. But then if you risk 1 to 2% per trade, is with $1,000 account, you can basically, if you risk 1%, you'd have to lose 1,000 times in a row for you to blow that account. So that's how I want you guys to look at this. So that's a really important thing. That's how you stay in the market for long, and that's how real traders trade. And then calculate lot size. Your lot size also, that's also something we're still gonna get into later on. Risk to reward ratio measures how your potential return for every dollar you risk, you know. And then the second point is 2:1 minimum. So here at the bottom, you can see I've, I've, I have a display for you. Sorry, I have a display for you here. So here, the first image you can see here says 0:1. So what I mean here is 0:1 is basically you risking more money than your profit. So your stop loss is larger than your take profit, basically. That you should never do that. And then the second one here is 1:1. So remember the here by risk management, where we were like, the ultimate aim is to balance risk to reward. So this one, I'd see it as like a more balanced one. You're risking how much? $50 to make what? To make $50. You know, that's like a balanced one. But then I wouldn't recommend it. You can be profitable with it, but I wouldn't recommend it. Then here's is the 2:1. This is the one you should use from here on upwards. This is what I would advise, because 2:1 technically means you're risking $50 to make what? $100, which is a fair trade. That's where you might even find yourself being more profitable. XFX 2.0 strategy. This strategy has been backtested over a period of 3+ years. It includes approaching the market from a top-down analysis point, which means starting with the bigger time frames to get the bigger picture of the market structure. And then you move down to the smaller time frames to decide whether to buy or sell the instrument you're analyzing. And the technical side of the strategy consists of trend lines and key zones, such as support and resistance. Top-down analysis steps. The first point is start analysis on daily time frame to identify daily support and resistance. The second point is move down to the 4-hour time frame to identify if the market is in an uptrend or a downtrend. Once that's done, draw out your trend lines and also spot out any current support and resistance if they can be identified. The third point is move down to the 1-hour time frame to identify trend channels within the bigger channels from the 4-hour time frame, as well as any current support and resistance if they can be identified. We also use the 1-hour time frame to forecast. The fourth point and the last point is once the move you forecasted plays out, move down to the 30-minute time frame for entry. So with all this, we're still gonna and go back to what live markets, and then that's why I'm gonna be displaying all these steps down so you can get a better understanding